Steve, thanks for joining us for the month of April closed-end fund market review. It seemed like the capital markets were relatively benign versus the first 3 months of the year. The S&P was up about a 0.25%. Barclays Ag was up about the same. Credit was relatively tame. So how did that translate into the closed-end fund market and returns?
Closed-end funds had a great month. They significantly outperformed the S&P 500. Many of the asset classes were up plus 200 basis points, bringing really strong year-to-date returns. Taxable bond funds are now up about 7.5% total return. Munis, we talked about last month, continued their run. They're up about 8% year-to-date. And equity funds are up about 200 basis points this year.
Steve, let's talk about discounts for a minute. I believe the all closed-end fund average discount was about 5.25 at the end of April. And we touched on this last month. Does that imply that the attractiveness of closed-end funds from a discount perspective is now less attractive because we've come in so much at 5.25, or are you still finding opportunities as you look through some of the sub-asset classes?
I think the bifurcation of the market speaks to the opportunity. When investors like an asset class, they bid up the closed-end funds to very narrow discounts. And so you look at the muni closed-end funds today, which make up a very large part of the closed-end fund market, they're trading at an 80 basis point average discount. There are many billion-dollar funds that are trading at premiums to their net asset value. Investors are completely comfortable with the leverage risk, apparently are very comfortable with the long durations of these portfolios, and they're willing to pay a premium to get it. Now, from an institutional perspective, that doesn't make a lot of sense to us, but that doesn't mean that the pendulum doesn't swing both ways. And we say that often, that closed-end funds become fearful at the lows and they become greedy at the highs. And so what it speaks to is the opportunity in the out of favor asset classes today. You've got munis that are at an 80 basis point average discount, but you've got high yield bond funds and bank loans that are trading, you can easily build a portfolio of those names with an average discount of 9 to 11%. And so when investors like an asset class, they bid it up. We view that if you want to take taxable fixed income exposure, the market's still giving you a very good opportunity to build a portfolio of wide discounts. Despite the fact that the average discount for bond funds is narrow, it's really just a bifurcation of the market where tax-exempt income is rich and regular taxable income is cheap. And then when you think about equity closed-end funds, investors haven't been putting money to work in active managers for a while, and so you can, again, despite the fact that the average discount's narrow, it's quite easy to build a portfolio of very wide discount equity funds.
So the message would be, don't let the all closed-end fund average discourage people from some of the attractiveness of other parts of equity, as you mentioned, and the credit portion of the closed-end fund market.
Yeah, as we said last month, closed-end funds have a lot of momentum. As a manager, we become more bullish on the closed-end fund space as a whole when parts of the market are trading well. It shows that investors are coming back to the market, and it proves the concept that discounts can narrow. We've been at wide discounts for many years on taxable fixed income funds, and it's right for people to question whether discounts will ever narrow. But I think the same question could have been asked about muni closed-end funds in 2013 and 2014. People said, why would I ever buy these funds? They have a structural disadvantage by having leverage and long durations. And lo and behold, we're looking at premiums just a few years later. And so I think when there's parts of the market that are strong, it gives us more confidence, at the top-down perspective that discounts can narrow in other parts.
Steve, last question. You have talked a couple of times in the past months about corporate actions and activism activity in the closed-end fund market has been on the rise. Can you give us an update on whether you're still seeing that, and has anything specific happened to funds in the closed-end fund market?
I think this month was certainly an important milestone in the closed-end fund market. You saw the AllianceBernstein Income Fund, a $3 billion closed-end fund, convert into an open-end fund. And that fund was trading at an average discount of 10.5% last summer. And what happened was institutional investors pressured the management company to take a discount narrowing measure. And ultimately, the fund company decided to convert the convert the closed-end fund into an open-end mutual fund. And so when you see such a large fund convert into an open-end fund and essentially give shareholders a 10.5% excess return in just a year's time, that encourages more people to buy into corporate action opportunities. And really, when we think about where discounts have been for a while, retail investors have abandoned the market really for the last few years on the taxable fixed income space. And who's buying those closed-end funds? Those tend to be institutional investors that are going to exercise their vote in order to narrow discounts as a whole. Management companies certainly can see the writing on the wall, and so they're taking proactive measures to get ahead of these types of dissident activities. You're seeing a lot of fund mergers, you're seeing a lot of buybacks, and really an attempt by management companies to keep discounts narrow, to keep the activists at bay. But it's, I'd say more so than any other time in the last 5 years, you're seeing a lot of institutional interest in the space. You're seeing investors that have typically been passive, taking a more active role. And that's ultimately resulting in, I think, an average discount that's going to be narrower because everybody has an incentive to get the funds to trade better.
Steve, thanks for your comments this month.
Thank you.